me to go? Right. Okay, all right. Well, firstly, I'd like to just start by sort of welcoming everybody here. Thank you for making the effort to come along and have a little bit of a listen around Are You Finance Ready? Which is the topic for today's conversation. Look, the great Australian dream of owning a home is obviously something that's ingrained in Australian culture. And you know, it's a highly complex thing, and certainly from the first time you're looking to do it, or even if you're looking to do it the second time, it can be somewhat of a daunting task. The challenges of finding the right land, finding the right build, bringing all these things together is certainly only part of the story. This expo that they're putting on, the inaugural expo that they're putting on to try and connect all of these things, is a wonderful opportunity for all of you to be able to connect all of the dots in one go and make sure that you've got your ducks lined up, as they say. The one thing that a lot of people miss in this whole journey of buying their first home or acquiring some land and building a home is the finance piece. And at the end of the day, this is a very critical part of the process. Are you finance ready today? That's the topic of the conversation. And basically what we'd like to do is run through some of the processes and principles and things that you need to consider when you're obtaining finance for your first home, or in any case for a refinance, or you're upgrading, or you're looking to invest, all the same. And obviously you're looking to make an assessment on whether or not you feel that you can afford the loan. So just to start with, the first question there that I guess people ask, what does being finance ready really mean? Buying a home is not only a massive life decision, it's also a very big financial commitment, and one that shouldn't be taken lightly. For the majority of us, we'll never have the luxury. I think we'd all like to think that we could just pull out the wad of cash and pay cash for the first home, but for pretty much 99% of Australians, that's not the case, and will always require an element of finance, sometimes up to 95% of the finance that they need to purchase the property. So being finance ready is not just about getting the loan from the bank. That's the other thing that people forget. This is not just about getting the money. It's about whether or not you have your financial affairs in order, whether or not you have the capacity to repay the debt, and ultimately that you're ready for the financial commitment, because this is not something that just lasts for 5 minutes. It's something that could be, well, for the next 10, 15, 20, 25, in some cases, 30 years of your life. So today what I want to do is take you through 5 key principles, and then two steps in terms of assessing your borrowing capacity that are the key factors in making an assessment on whether or not you are finance ready. So to start with that, the first thing that these are the things that we're going to look at today. So the first thing we're going to assess in these influential factors is your credit history and the role that your credit history plays, somewhat misunderstood at times. The second thing we're going to look at is your genuine savings, understanding how that works and putting your deposit together that the bank requires in order to obtain finance. The third factor that we would like to look at is income. And that might seem very simple to people. I work, I'm either self-employed, I'm PAYG, I earn my money. But from the way the banks view that, all industries are different, and we're going to break that down today because that can have a massive impact on how much your maximum borrowing capacity is. The fourth factor is your living expenses. We'll break that down into, you have 2 types of living expenses. You have fixed expenses and you have discretionary spending. And these are all the key factors that the lenders think of or have to work through when they assess how much you can borrow, which ultimately will determine how big your house is or how small it is for others. The fifth pillar that we want to look at there as an influential factor is the liabilities and loans that you have that are pre-existing. This is things like credit cards, car loans, personal loans, and so on. So we've got to work through that. Then, once we've gone through those 5 factors, I basically want to summarise that and give you an indication of how they impact, 1, your borrowing capacity and affordability, and 2, a determination on how much you can borrow, which is obviously something that we can help you with, because this factor's very important as well. So the first thing I want to take you through is understanding your credit score. As I said, there's certain factors that happen in your everyday life that you're not even aware of that have either a positive or a negative impact on your credit score. And obviously it stands to reason that the higher your credit score is, then obviously the better you are seen to be as a potential borrower for a lender who's going to give you money. So to break these down, if we're to look at, and from a lender's point of view, they're governed by APRA, which is the Australian Prudential Regulation Authority, and they're the ones that put a lot of these rules down on the banks, and all of the responsibility is on the lender to make an assessment on whether they feel you're in a position to repay the loan. Seems strange. You'd think you, as the consumer, would be the one that makes the decision on whether you are in a position to, but a lot of that onus is on the bank. So in this case, they have to take these things seriously. So this is a determination or a measure of people's human behaviour that basically, it's all algorithm based in terms of things that happen on a day-to-day basis that might impact whether you will be a good borrower and pay your loans back or whether you might enter into default. So the factors that could positively affect your score, and these are things to put in the memory bank, could be factors that it's the stability of your job, not having gaps in employment. It's not so much a trouble if you move from one job to the next, but it is having that consistency. And that's the same even for where you live. If people move around a lot, those things affect your credit scores, right? So these little factors, it's not just about your repayments, but other factors that will positively is paying your bills on time, making sure that your credit history and your credit card payments are paid on time. These things all attribute to your credit score. So as you can imagine, on the flip side of that, from a negative point of view, all of the opposites of those will detract from your credit score and ultimately make it harder or reduce the amount of money that you can borrow, or ultimately the rate that you might pay for your home loan. Because a lot of things are priced to risk. Interest rates are sometimes determined by how much you're borrowing and how much this credit history affects your ability to repay. So that's pretty much the first factor that we have to consider, and we'll summarise these. We've only got half an hour today, so we can't spend an enormous amount of time on these things, but we will be available for questions at the end. So the second factor or influential factor that we'd like to discuss, and for most people it's probably the most important one. Whilst it's only one part of the whole process, it is probably a key factor, because ultimately if you don't have any income, then no one's going to give you a loan. But the way that the banks might assess that income, funnily enough, is not quite as simple as people would realise. For example, your industry may determine how they determine your income. And all of this ultimately comes back to net income. Not your gross income, it's the after-tax, it's the net income that you bring into your home on a monthly, weekly, fortnightly basis that they're going to use as a figure. But how they determine that net figure can be very different across lenders. We deal with over 35 lenders, and every single one of those assesses income differently, depending on the types of clients they want to attract, the type of business they want to attract. So for example, if you were in emergency services, some lenders will actually assess, and in emergency services there's lots of overtime, there's allowances, these things. Some lenders won't allow allowances. Other lenders will make an assessment over the security of an emergency worker that there'll always be work there, and they'll actually take 100% of that net income, right? So a little factor like that, and then it's the same for hospitality, it's the same for casual workers. The way they assess the income, they might put discounts on how much they'll apply to your net income, which ultimately will determine how much you can borrow. So for an example, just bear with me here, for an example, you might go to lender A, you might bank with CBA as an example. So that's where you walk into the branch, and this is one of the benefits of a broker. You walk into that branch and you have a type of income that CBA, against their policy, doesn't use. That's going to lower the amount of money that you can borrow. And you might have your heart set on a particular property that requires X amount of money for lending, and you won't be able to get that loan. But you might be able to walk next door to ANZ, who's has a different attitude to their risk assessment, and determine that they feel that is an adequate income to use. And by using that income, that may mean that you can then service the loan that you want. And we're talking, in some cases, these be by using or not using some of these incomes. We've seen circumstances that would relate to somewhere between 100 and 200,000, sometimes even more, in your maximum borrowing capacity. So you might only be able to borrow 500,000 or 600,000 with one lender, but you might be 750,000, 800,000 with another lender. So we have the ability at our stall over there within 5 minutes to be able to make a borrowing assessment across all 30 lenders, breaking it down to all of those incomes. So from a self-employed perspective, this is even more complicated. I won't go into that today, but that's a whole other story. Self-employed people we dig into financials, and there's a lot more things that they will and won't consider. But understand that assessing income is not just as simple as this is how many dollars I bring in each month, because the lenders will decide what they use and what they don't. So the next topic that we want to look that's very influential in terms of buying, and this is probably more factored towards the first home buyer, is how many people here would be looking as first home buyers that are here today? Yep, so there's quite a considerable amount here at the House and Land Expo that are looking at first home buyers. So genuine savings, essentially, what is genuine savings? It's basically being able to prove that you have some capacity to save. You've never taken on a debt like this before, right? So the bank wants to see over a certain period of time that you've been able to take a percentage of your net income that you get every week and put it into a bank and show that over an agreed period of time. So to give you an example of that, it's usually 3 months of genuine savings, right? And it needs to be equivalent to 5% of the purchase price. So if we were buying, for example, a $500,000 home, you would need to show that you had progressively saved $25,000 over a 3 to 6 month period in a bank account, right? Now, times have changed. In the old days, that was fairly hard and fast. It needed to be savings. Obviously, there's other factors over time that they've realised you can use. So for instance now, other things that can be considered as in conjunction with what you put into a savings account to formulate this 5% includes things such as managed funds, or if you own a few shares. It also might be that you've got a solid rental history. So if you've been renting for a period of time, they may consider that towards it. Understanding that not every lender, again, will do that. You might go to your lender and they don't do it. Another lender might accept that, so that can be the difference. There's some stuff around superannuation. We won't go into that too much. It may be for those that are looking to purchase again or in a second time, or get a new home. Then they will look at existing equity as well. So if you have an existing, because you've already shown that you've been able to save and get an asset, so the requirement of genuine savings in that circumstance is then waived. And it might also be if you've sold. So if you've got a property, you sold it, you put the money in the bank, well, that would be considered genuine savings as well. So, next thing I want to talk about is assessing living expenses. This is another key factor that is very critical in assessing whether or not you can borrow the certain amount of money that you would like. So, when the lenders, as I said, the responsibility is on them to determine whether or not you can afford this loan. If you end up in default, they get in trouble, right? And they have to show that they have, done adequately researched your circumstances to ensure that you weren't put into a position of hardship. So there's two categories when we talk about living expenses. There's fixed expenses. Fixed expenses are clear. It might be insurances, utilities, existing facilities like credit card repayments, store cards, these sorts of things. They're fixed expenses. You can't really get away from them. We have to have them. Then we have our discretionary spending, and this is obviously very subjective. This could be, how much you decide to go out for dinner, how many times you go to the movies, all of your lifestyle decisions that you make. These things all equate to your living expenses. And when the banks assess this, basically how they do it is there's a thing called the HEM. It's called HEM, Household Expenditure Measure. A whole lot of academics put this together, and they make a determination on whether you might be a single person or a married couple with 1 kid, 2 kids, 3 kids, income brackets, all sorts of things. And they predetermine, based on where they put you, how much the minimum living expenses would be required for that person to live. And they apply that as an expense against your net income every month. They deduct it when they do their assessment, they deduct it from your income to determine what's left that you might be able to use to repay the loan. So as you can imagine, discretionary spending is one of those things that has a massive impact on overall borrowing capacity. Now, whilst the lenders will apply a minimum, they will also seek to validate it. So we need to give them statements, in most cases, 3 to 6 months of statements that shows all of your living expenses. And ultimately, if your living expenses on those statements is higher than their minimum, guess which one they'll use? The higher. They're always taking their risk mitigation position, and they'll always take the worst of any scenario. So obviously it's very important when you're preparing and working towards getting your finance for the first time, is that you manage your discretionary spending, because it's going to make yourself look better in the lender's eyes and increase your borrowing capacity. Whoops. Okay, the fifth factor that I'd like to discuss is assessing existing liabilities. This is a real one that gets people as well. All of these things seem simple when you think about them, but they're actually not. When you make an assessment on liabilities, if you had a car loan with a $600 a month repayment, that's really easy. They'll apply $600. But some people have store cards, credit cards. These things have massive influences. I'll show you those in a second in terms of the impact they can have on your borrowing capacity. And that's whether you use them or you don't use them. Even if you don't have 1 cent owing on them, they still need to apply an amount in case you use it. So some people have, $30,000, $40,000 in some cases. Oh, I don't use them, or I might pay bills on them and then pay them off so I can get points, these sorts of things, but they have an impact. So how do these impact you? So if we look at a credit card, if we take that as a prime example, because this is the one that gets people, or this could be a store card. You've got that interest-free, 50 months, 10 grand, and then you don't use it, you stick it in the drawer. When it comes to the bank, they have to apply usually somewhere between 3 to 4% of that, or in some cases up to 5% of the actual limit, and apply that as an expense. So we've now got your net income, less your living expenses, less your commitments, and we're getting less and less available to meet the commitment of this new loan. So as you can see here, for example, if you had a credit card here with a $25,000 limit or a $15,000 limit, you can have somewhere between $600 and $1,000 of your net income deducted away by borrowing capacity to buy that home, which again can impact what it is that you look to purchase and whether you can get what you want. Does that make sense, guys? Yep, good. So what I want to just touch on now is tips increasing your borrowing capacity. So we've kind of gone through the 5 key factors, and I will summarise those towards the end. But if we look at the ways and the things that are available to you that you need to use in order to work out or maximise your borrowing capacity, these are sort of 5 things that we've looked at, right? You need to get rid of any unnecessary debt. Credit cards is a big one. If you don't use them, close them. We'd probably recommend that. The funny thing is, once you've got the home loan, getting the credit card again, funnily enough, is easier than getting the home loan in the first place. It's a bizarre thing, but that's the way it works. We can sometimes not get a home loan to pass servicing. We finally get the loan, and then someone can go out and get a car loan. It's just a different set of rules. But when it comes to home lending, we need to be able to get rid of any unnecessary debt. Sometimes, if that's not possible and you've got a number of debts, then we might look at seeing how we might be able to consolidate all those into one loan for you, and take it over a 3-year term, might be a 5-year term or a 7-year term, to reduce that minimum repayment and obviously increase your borrowing capacity. That's a big one. The ultimate one is obviously save more. That's obviously challenging. It's not as easy as it sounds, but being able to save and contribute a bigger deposit will ultimately be a way of increasing your borrowing capacity. And the next and the final thing on that summary is obviously looking at being aware of your credit, thinking about it on a day-to-day basis. Keep your accounts in order. Make sure you pay your bills on times. When you're going for a loan, don't think about having a life change and all of a sudden, I might take some time off work and then work out what I want to do next, because those things will impact you, because lenders might need to see you in that new job for 6 months before they'll let you use any of the income, right? Or it might be a casual role or in probation. All of these lenders have different policies that apply, and that's, I guess, where we come in. So moving on, we've covered sort of 5 factors. As I said, this is only a half an hour presentation, so we try and wrap a lot in a short period of time. But from a borrowing capacity point of view, we need to consider 2 things. There's the lender's assessment, and then there's your own assessment. And your own assessment is based around affordability. It's not necessarily related to how much the bank says you can and can't borrow. And sometimes they can go both ways. Sometimes you might be very diligent with your money, and the banks are applying minimum living expenses that you don't spend, and you feel that you can afford a great deal more than what the lender allows you to. And vice versa. You might find a situation where the lender is saying you can borrow $1 million, but you are not comfortable with that. Because there's emotional factors that come into this. This is not black and white. You need to make an assessment based on, how that might impact you emotionally, the impact it may have on your relationships, and those sorts of factors are very clear and important as well. So part of our role is to obviously help people work through that and determine where your affordability sits. We usually start with borrowing capacity. It's always nice to know, well, what is the maximum? And as I said, we can make an assessment on that fairly quickly. But from there, we need to then dig deeper and get some fact finds, look at your expenses and work out, can you afford this loan? What if interest rates are to increase? I mean, in recent times, most people are a bit frightened of that at the moment. The reality is that's sort of where you are at the moment, and that's actually probably pretty reasonable over the last 10 years. It's just that we've been through COVID, where we all of a sudden had 2% and fixed rates at 1.89, and all of a sudden 4.5% doesn't look attractive. But the reality is it's reasonably affordable at 4.5%. So these are the factors that we want to look at. You need to decide at the end of the day that the decision's yours. It's your money and you have to decide what you can afford. So just to summarise what we're talking about here, I guess is these are, and I know these screens aren't necessarily easy to see, but the things that we're just talking about there, if we summarise this whole sort of presentation to this point, is looking at when we're making an assessment on borrowing, we are making a full assessment. Our role, again, like the lenders, is we have a duty of care. We operate under best interest duty, so it's in our interest that we don't put you into hardship as well as brokers. So we need to make sure that we can not just take your word for it, but we need to verify the following information. We need to ensure that we've checked your income, your assets, we do credit checks, we check your savings history, we get rid of debt, we look at your expenses and all of the factors that are on the screen there to ensure that we feel that you're in a position to borrow. So I guess if we move on from there, the next thing I want to talk to is why use a mortgage broker. I think the stats last month were that 75% of people in Australia now use a mortgage broker. I've been in the industry pretty much all my entire life, so I've had nearly over 25 years experience in the industry. I've seen it grown from being in only 10% of the market to 75% of the market. And I think that shows that we're a trusted solution to the lenders. And it's for many reasons. One, the lenders struggle at a retail level to provide customer service. That's the first thing. The second thing is they can only sell their own products. We don't sell anyone's products. It makes no difference to us whether it's ANZ, Macquarie, CBA, the list goes on. For us, we work for you. We ensure that at the end of the day, it's the lender that pays us, and lender A, lender B pays us. You don't pay us. And it has no impact on the rate. In most cases, we'll be able to negotiate, if not the same or if not better, rates than you can if you walk into the branch, because they'll just give you the product they want to sell. Because to them, the better the rate is. Okay, we'll just. So from that perspective, as I said, we'll do the search. We do all the comparisons. We've got the software and technology to make these assessments. We'll get you your maximum out of the income that you use to be able to manage your expenses. And we do all the heavy lifting. You don't do anything. Basically, our guys, they can work remotely, they can see you face to face, but we do everything. We can collect all the information, we can compile it, we do all the negotiations with the lender, we manage it through to settlement, and basically you don't have to do anything, and we take that stress-free out of it, and we're there on your behalf. And the other thing from our perspective is just the experience. Obviously, for most people in the room, they're doing this for maybe the first time or the second time, and you've got all of our years of experience of being able to navigate that highly complex environment of lending. So why use financial? So moving on to why use mortgage broker, I guess why use financial. Basically, we've been in this game for 15 years. We've got nearly 20 odd brokers that work for us. We've got a team in a settlements team. We've got a post-customer care team. We've got a lot of people that can look after you. We've won a considerable amount of awards, and I don't say that to build a statue of ourselves, but to give you confidence that we are highly recognised and regarded in the industry, and you only do that if you do a good job. So I like to make that point clear. The other thing is we've got over 7,500 already active customers, probably getting close to 8,000 now, that have dealt with us over the last 10 to 15 years. And we've got a highly experienced team that is there to support you. And probably more importantly is we review your loans annually. A lot of people say they do, we actually do. So for example, your review comes up, we push the existing lender for pricing. So sometimes when you go to a bank, they'll give you a rate, and then over time your rate becomes uncompetitive. And then you might see on the news that they're offering a rate to a new customer that's lower than what you're paying. So we're basically there to keep them honest. Every year we will price against that lender. We've got technology that enables us to do it, to ensure that we will go and say, hey, Bankwest is offering this new to bank rate. If they don't give it to you, here's your options. So we'll try and negotiate on your behalf. From a lender's perspective, they're not going to do that because they lower your rate, they make less money. It's pretty simple. So we're in your corner. I think that's, what's happened there? There was a couple more slides, but they've gone. Anyway, that's okay. We can deal with that. Was that the last slide, was it? Sorry? Okay. I think there was just a thank you. But anyway, what we're going to do next is... there we go. That one there. I must have clicked past it probably. So we're here. We're in the stand just down here opposite the kids, giving away chocolates to attract all you people to come in and talk to us. So, but you're welcome to take them yourself. At the back of the room here, I will take some questions if there's any specific questions. But we're just going to hand out some bags now because I don't know if you've seen, but we've got a thing called a deposit booster, which is a booth that blows money up into the air, one of those cash grab type ones. And we've sort of played it as a little bit of a gimmick, you know. So most people here are trying to put their deposits. So we've been giving every hour someone an opportunity to go inside that deposit booster and just grab as much cash as they can. The last lady cheated, grabbed off the floor and walked away with 800. But typically people are getting a couple of $100 or whatever, so it's just a bit of fun. We're going to hand out a bag, and when that bag gets out, I'll tell you who's going to be the winner to jump in that the next time. And whilst the team does that, I am open to a couple of minutes we've got 2 or 3 minutes left. So if there is any specific questions, welcome them. Otherwise, I want everyone to enjoy and come and visit us at our stand. Any questions? Good. Hopefully that means I covered everything. Right, so everyone's got their bag. If you have a look on the bottom of the bag, someone should have an X on the bottom of the bag. Who's got the X on the bottom of the bag? Hope they gave the one out with the X on the bottom of the bag. Oh, the lovely couple in the corner here. Congratulations. Give them a clap. All right, what time? I think we're going to do that, Lee. What time? What time are we doing that? 5 minutes. So if you wanted 2 hours in 5 minutes, one of you can jump in the machine and see how much you can grab. So, look, we thank you. Thank you for the opportunity to speak. We are here. We've got a good team of people that if you want to come and have a chat to us. And thank you for listening. Appreciate it. Cheers.